You're going to hear this first. No one else that I've ever seen is discussing this, and it's a slightly bizarre. And some people would say, why do I even need to care? Because it's a global world, and there's potential for contagion. South Korea is essentially like Japan, but a smaller version thereof, a slave nation to the Western hegemony, and will quite easily be potentially sacrificed. And we're going to see a major deval in currency for South Korea. And that is going to be to the tune of a minimum 50%. Now, that's a very advanced nation, high IQ nation. Your company champions, you think of Samsung, LG, Hyundai, and, Kia, popular vehicles. They're good engineers, they're smart people. They've actually got a worse demographic than Japan. I think it's 0.88 to Japan's 0.91 kids per couple. So, they've got some interesting demographic issues. But my personal feeling is that this is probably going to come down to a unique structural aspect of how they work in their stock markets and their pensions. In other words, it's not only America that has some form of Ponzi-onomics going down. And I think South Korea is about to get a negative attention.
It's November 11, 2025, and my guest today is Francis Hunt from the Market Sniper, Crypto Sniper, and Reset Sniper YouTube channels. Francis, thank you so much for coming on the show, my friend.
Glad to be back with you, Danny. How are you keeping?
Good, man. I'm looking at the price of gold today. We had a massive rally yesterday. Things are moving a little flat today, but that's okay. We had a big green candlestick the other day. Currently trading at 4,100 and some change here. Silver's at over $50, back up again. Let's go ahead and kick things off. Get your prognosis on the metals trade. What's the latest there?
Oh, great news, I think. I like being able to say, yep, good stuff is coming, and that's very much the camp I'm in. So I'd like to share charts, because these things are best done visually, Danny. We actually did a community-specific update. And what I chose to do was, guys, this is what I think is going to happen, and here's how. Some of the guys that hadn't got long, we had already got long quite early. We had a live trading day that we would jumped on Friday, and we saw that there was a little bit of a test to the upside. We said this could break up, because previously we're saying, you usually get 3 waves of selling. So let's just cover where we were at. We called it double top eventually. That triggered once we started getting that sell leg off. So you have what's kind of an M head, just the recent history. So this is the corrective part. That's a neckline, that light blue line. Then we ran into this inverted HVF structure that gave a target to the downside. I've drawn it a couple of times. If guys want to see the specifics of it, it gave you an exit over there, which is a downside move. So you'd had 1 big sell move, 2 big sell moves. There was a possibility, and typically we never short in a macro bull, but there was a possibility this could have gone either down or up. You could have had a third wave selling. The way you negate that is you break to the upside. And that's exactly what the market did. In fact, on Friday, it did this candle here. I'm not sure if everyone can see it, but it went up first and then got beaten back. It looked like a failed breakout. And then it sat back down on the 4,000, very key level. You'll see the blue line.
Just really quick, friends, from what I can see here, these are 4-hour candlesticks. Is that correct?
Correct, yes. I should have been more clear and stated that. 4 hours, we're looking at the gold price on a 4-hour time frame, and we're highlighting what I think is coming next. In our community update, which I did last night, I said for those that weren't long, they're going to be given an opportunity. I'd already drawn this blue line on, and it's beautiful how it's done exactly what we expected. When we updated, we were here. And I said, don't whale in with leverage now. We have what is effectively a right, my apologies, that's the left shoulder, ladies' right, I'll get in trouble for that one. And then we have a head here as the larger bottoming. And I said to them, we're limit orders in and around the 4,050 to 4,100 box range, I think we're going to get a right shoulder pullback from this neckline that we've chosen, which is at 4135. 4135. So we warned, nice strong move. We were lucky, some of us, to have got into that. There was actually the upside HVF in there that gave a target. I'll draw it in a second. But this is exciting stuff because gold is king. And if he gets up from his chair and moves, we saw the reciprocal move with silver and platinum starting to get a bid again. So let's just draw on a lower time frame what's happening and drop again by half. That's a two hour that I'm now on. So when we saw the structure that's actually going to be upside, because it really was a 50-50 call as to, you know, which direction will he go. We drew it here. That was it. And we said, look, if it targets that, it doesn't need to put much more on. Typically, our targets are run through. So the purple line is our target, by the way, that was generated. That was the clear break in the end that ran. That's where stop losses would be placed. That's where entries would be placed. You could, if you're aggressive, get in a little earlier with your stop on that low 3 there. But that target was met, and we said, look how close it is to a round number 4135 that beautifully encapsulated the resistance levels. Again, they should be just run on the way down when you are setting up this structure. And what you end up is with that inverted HVF turns into a left shoulder. The other, when we really chop up, because we really chop up charts, it's what we do. We love it. We love technical analysis. We have the unique HVF method that is very powerful to do it, and we get a lot of pattern analysis out of it. Inside of this, there also was what we call the soft W bottom. So you'll see there's a blue line there. This is your high momentum, call it your left glute, spiky left glute, and this is your more smoothed out, rounded, not as deep, and lower volatility. It's exactly what you want to see when you are seeing recovery. First, you're coming down hard and fast, and the market is spiky. It was quite evidenced in the inverted HVF. These have sharp moves. They are brittle. They're pumps and then dumps. They're harsh. And you go into that left side of your W bottom. So that also was giving a reversal that's given this key neckline of the double top that I started the explanation technically showing you. So when this W goes up, it will probably have a little bit of a pause rest after running the 4-2, which was support also turned resistance. So it's amazing how, when you do pattern analysis, how everything reaffirms key levels of significance. This is folded here. I said to the guys, put your limit orders in at the 4,100. We gave a range. A little bit below 100, down at 4075, up to 110, 120. Some of those, depending where they put them, I give them what I call a limit buying box. Some of those, depending if they were on the high side or the low side, will now have been filled. We don't expect the shoulder. So this is what you learn from the one half. So here's the half. I'm going to divide the price behavior in half. This was high volatility, mainly downside. Yep. Down, down, down. This is the slowing of the volatility, more rounded bottoms, and more steady climbing side. So the expectation here, and I'll use another color just to do it, is that whilst you've had a let go of that 4135, that was a little bit abrupt, that broadly you're going to do something more chilled, less deep, and more rounded as a right shoulder. And that typically comes like that. It should not be violent and volatile, because then we have problems. More loopy like that, convexity and concavity. So that's what we're looking at. So you will emulate the more calmer side of the W, where the W is your halfway mark. What does this all mean? Well, it means buy limits in this range and a tiny bit lower may well get filled, and that you have a target on that of around 4,400. So we guess our neckline, and we haven't needed to change it. It was a good guess. It's a key round number that was run 3 times. And you can see there was an attempt at support when this wick shows you here. So it showed us was a key level, and what's happened? It's run that level. And now it's having a pullback. So it looks to me like it's complying to an inverted head and shoulders. I've drawn the 2 shoulders, one still in formation, which we expect to be more relaxed, less spiky. And also the W bottom triggered. You'll note that the movement, if we go back to how it moves. The W bottom had that blue line there. So let's again just draw that. So you've got two reversal. They are embedded within each other. So it's kind of interesting like that. So there it is. You will note that the movement was very strong from when our HVF method setup broke. See how the HVF gets you in before the break and gets you the fastest part of the move. That's where you're nearly vertical. And then from there, you're going more at 45 degrees up. So you can see the inflection point of that W bottom neckline. And when you get to the major neckline, the 4135, you can see the resistance and the pullback coming into play. So it looks very much like, we can be wrong, by the way. And how do we get wrong? If I start to get precariously concerned if we were to come past and down to the lows of the previous shoulder, because this was a volatile, fast dipping, fast back up shoulder. This should continue to show that there's reduced volatility. There's not so much leverage that needs clearing out and late dip buyers and frenetic. Gold has gone off now that it's not making highs every day. It's gone a little bit off the news wires, and that's exactly what the price behavior is reflecting. So you should be back at 4.4 if this pattern performs on balance of probabilities, providing we continue to see this. This is not a bad entry point. You might get slightly better, providing you patience. And then there's some form of trigger at the 4135. You may get a rest and a wind up when you do 4200 because of the legacy neckline and the target of the W that I've drawn. But you should stay the whole race because there's a 4.4 waiting for you. So with gold doing that, that's going to be extra good news for our friend silver. So I'm hoping that people are enjoying that.
So you're saying gold breaks. So you're saying gold breaks out of this $4,500 range sometime soon? What kind of?
So the target there was just under 4,400 on the gold. It was around. So it's going to take a new high, but it might rest on doing that. Look, patterns can still also fail. Let me go back to the gold. It can also fail. I don't like that it's so close to the previous high. I generally prefer if you either stop before the previous high and come back down and wind up to get a new move and new structure. To go marginally higher, I'm not a mad fan for marginally higher. So we'll have to see. It could have a rest and just do staircase. It would be better for us if we set up something that gave us some compression and some real momentum. Just from a trader's perspective, we're not a mad fan for marginally higher highs, but it could make a marginally higher high, have a minor dip, and then just squeeze higher, like a rising wedge or even a channel. That's the more frustrating price behavior generally when you squeeze higher, but we get whatever the market chooses to give us. So that implication of 4,400, it's 4,397, we'll take out the previous highs. The previous high was 4,381 by a handful of dollars. So you will get back to a all-time high if that target performs as we anticipate. But you may rest. You don't want to be the late guy, woohoo, new high, chase in, and then you get a $100 drop from 4.3 back, from 4.4 back to the 4.3s just under again. So always at an investment level, massive precious metals fan, of course, a lovely 100-ounce bar. Put that next to your phone. You won't get irradiated while it's charging.
Is it really?
Yeah. That metal is unbelievable. It's silver has so many good points to it. I mean, the colloidal silver from antibacterial. I mean, if I could, I'll make a bed frame out of solid silver one of these days. I'm telling you, you'll sleep better, you'll deradiate, you'll ground better. All sorts of things. They use silver thread in Tour de France cyclists like sheets to help them recover faster. It truly is an incredible metal. It's, these things are precious metals for a reason. They're scarce, but they actually have incredible properties as well beyond that. But anyway, I don't want to take you into biomedics and everything else, and my knowledge is more limited there anyway.
Separate podcast.
Yes, exactly. Separate podcast, more research. So for me, these are PMs are going to be coming back, but I'm not sure if it's going to just be a rip. I think it's going to make a marginally higher high and then pull back. What you might get is slightly different behavior from silver. Silver, again, itself has pulled all the way back similarly, and it has come and met and had a pullback with gold. It's beautiful how, while gold was meeting an interesting level that we had chosen, which was the equivalent of these highs here, which is the right shoulder, silver has already come back and met its reversal pattern. It had a head and shoulder, not a double top like the M top that you saw there. This was a head and shoulder. That was the target. You can see it made that target to the downside. Done and dusted, contract done. No further downside. You're back at the neckline here. So it was quite typical. This is what gave us confidence. Don't go in now with leverage if you hadn't got in over here. Don't go and do it now, because you're probably going to get a pullback. What have you got? You've got your largest downside candle since this move up began. So again, a little bit of basing around here, and then further potential upside. There is a slightly sketchy inverted head and shoulder for this one. It's very interesting in that it's almost married up to previous price behaviors, blue lines. But if I were to draw, I put that 49 in there as a key level of significance. And isn't it interesting that it's almost the perfect neckline? If I were drawing the neckline now, I might have made it a tiny bit higher going through all of those to there. But 49 is very, very much a key level. So after you were selling off here, the 49 just run rejected, the 49 just run rejected. A weak final attempt to get it failed. And then when you came back up, 49 just run rejected, 49 just run rejected. And then this winding up squeezing process to smash 49 and get you to the neckline, which was, wait for it, $50. Key number. Great to have a 5 in front for every ounce. You know, that makes this sucker $5,000 in a sense. I mean, and we'll be seeing a lot more than that on macros. We've told you $333. Don't forget. There's going to be real excitement on silver. So in terms of its down legs, silver has almost pulled back more so than gold. So whilst gold may make a marginally higher high, you could be in a situation where silver will be doing a little bit more than that and overextend, depending how much it gets its roller skates on. That's going to depend on whether we're unwinding the gold-silver ratio to the downside. So we owe ourselves to have a look at that one, XAU, XAG, and put that in there. You can see this one is coming again to the downside. We had a little push almost to go higher at one point.
And this is a multi-year view. This goes back to what, in 2022?
This is a weekly view, yes.
Oh, weekly.
So I was mainly highlighting the entrapment area we've been in since 2021, really.
Yeah,
mid-21.
That's what I meant. I mean, meaning it goes back multiple years.
Yes, that's right. Yeah, so we got multiple years in that. And we actually warned if we had a shock and awe event that it could even go up. That hasn't really happened apart from that period there, and it didn't follow through on. So silver's getting some of the respect, but we haven't truly left the stall box that we are kind of in. There's a sort of 70 to 94 box here. Yes, you had a fake break out to the downside here, and you had a kind of a fake break there. We are heading to the downside. We'll have to see if we can follow on. This is an important one to watch. If we can let go of the 72, the 74 and 72, run this low, I think this is around 72, with the next key level is 65. And that would be, I would say, then you want to be primarily buying silver at that point. I would even be, I'm doing that now. So I've loaded up on silver and platinum over gold, where I've normally been saying to a lot of people, you shouldn't jump to the next stage too soon. So we've been stacking gold for a lot longer, and gold has been the overperformer of, if you look over the last years. Gold's the one that's made an all-time high, not silver yet. But now we're probably, if we assume that this breaks, a big assumption, but it's probably heading in that direction. If this breaks and goes to the downside, the best part of the performance will be coming on silver and platinum, whilst gold will still be doing very well. So yeah, that's the level. So have your alerts there. I'll probably also just pop a few on the high side in the event of a crisis, and maybe an engineered crisis. leading to a bit of industrial demand sell-off, but that's it. The other thing that we'd made, and it's probably worth mentioning, is that we'd warned everybody that you should be long gold and short oil. And so many people have, are so tempted to pivot into oil right now. And we are just like, no, don't do it. Don't do it. This is a monetary collapse. This is a monetary collapse. People need to understand this is a monetary fiat and debt-based collapse. And the real value, and we did this YouTube on that day over here. Again, we're talking a lot of inverted head and shoulders today. We did this one, and it's the second time we've called inverted head and shoulders on the two. So this chart is gold divided by oil on a weekly time frame, so that I'm clear. We said this is a secular reversal. Oil was at 129 after the zero of CV19. It had a major relief rally where everyone went to not, you couldn't even get it for free because you would have storage costs. Nobody wanted it. The whole world had shut down. To suddenly all the offshore rigs were literally pulled in just about, and there was very little production and everything was wound down, and everyone went back to work and started driving and buying cars and flying on holidays again. So you saw a snapback rally. Oil was at 129 down here, and gold was still below 2,000. We called the 2,000 break. At that point, gold started to move very strongly, and we warned that oil will be an underperformer. And this is exactly what you got. You've exactly what you've got through here. And we still see that this is a reversal. When you have we're in hype, and this gives us our economic models. We're in a controlled demolition, and the way they're doing it is hyper-stagflation, which means you actually are having the consumer and the man of the street actually be in quite a poor place. Job options are lower, salaries are lagging the true inflation rate. Watch for the lie of CPI. And you're in a controlled demolition that's leading to hyper-stagflation. What that means is economic activity is actually being throttled, which is very bad for oil. Oil is the thermostat in the sauna that tells you how hot the economy is. And oil drops, it's a very cold sauna that it's not doing the job. And it comes down immensely. It's very sensitive to deliveries, buying on Amazon, etc., etc. So not a good indicator. So oil has been poor, but we're in a monetary collapse, and that's what we're seeing. Gold is running. So the dollar is devaluing, and gold is the true monetary replacement, the original. And that is why you want to be long the one, short the other. This is your hyper stagflation trade. So many people going, oil's so cheap, this correlation has to do it. Let me just tell you how extreme this can get, because we've called this same pattern in 2019. Little reminder, you might see the spike in there. There's the same pattern, by the way, that we called in 2019 as it was triggering. You can see it here. This is a setup. We came up there. We said, okay, is it going to be done? Same structure. This is again, it's still the same chart. It's just earlier. Sorry, let me just draw and grab that. There's your left shoulder. There's your interesting M head and right shoulder. And we are saying, watch, this is going to break. And you're going to go from, there was lows of 15, that means 15 ounces of gold it took. My apologies, you only got 15 barrels for 1 ounce of gold, 15 barrels of oil. And then the neckline up here was around 28.5. You can see it. We said, watch out, it's going to go well through 51. And you got the super break, or essentially infinitely big, where the scaling has just gone insane. That was CV19. That was a major blow-off spike. When they have a problem in the economy, they need to make oil super cheap, because otherwise nobody takes on any activity. I call oil the Rockefeller tax, and it's a thermostat subject to the real economic heat and activity in the economy. A low oil price tells you the economy is not generally good. You can't say that universally, but it's a very good indicator.
Right. So quick question.
Let's leave that.
Yeah, quick question. Now, in COVID, I mean, they literally shut down the world economy, and they were able to get oil down into negative territory. But of course, that was an anomaly. It didn't last for long. But oil hovered around $30 to $40. That was with the entire economy being shut down. Will a recession? I mean, how can a recession compare to a worldwide shutdown, though? If oil is such a pivotal commodity to the lifeblood of the economy, if they couldn't even get it down below $40 to $30 with a worldwide closing of everything, I mean, what's a recession going to do in this case?
Well, you can see we're not actually that strong on oil. I think we must be around about the low 60s or 59s. We can get the update on it. We met our targets for that, but the reversal is still ongoing. At the moment, you're 61, but this is a very soft price. Don't forget, this is in diminished dollars in a year that the dollar has been probably the worst major currency. So this is a monkey on a greased pole, and he's barely able to hang on to the 6 handle here. You're trading 61 at the moment. And so this just, my point being is not all commodities are the same. Gold shouldn't be viewed as just a standard commodity. It is money. It is a monetary-based collapse we are going through. It is, and that is the substitute for debt, fiat, which are the same thing. Debt just being fiat that's owed later, which has a rent agreement attached to it. So it's a fiat debt collapse. So the only alternative is monetary, is gold and silver and platinum. And the only outperformers to gold will be silver, platinum, miners in the traditional finance world. We do have 1 or 2 cryptos that we think that they're going to be uploading and boosting at some point. I don't trust crypto. Anything that's digital is probably co-opted for me, but I will trade and make medium-term investments in there if I think it will outperform gold. But if it's not offering a technical outperformance to gold, gold is your new measure of account. And that's how you should be looking at everything. You'll note I do a lot of charts divided by gold ounces. I mean, we're not in the crypto space, but let me just, for variance of topic, just show you how technically this chart on Monero looks so much better when you actually divide it by gold. You can see that high is actually higher than that high in just dollars. Here I come and I divide it. Are you worth holding? Is there some point where you will outperform for me against my benchmark, which is gold? And this is what you find. This is the chart you then get. And actually you get a far better chart, far more squared up, that is in gold ounces. So gold's adjustment.
Are you sharing it? We can't see it.
Oh, sorry. Let's just do that. I apologize. I switched off the share screen. Let's do that again. And share.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
So let's just do everything I said over. If I just show you this one privacy token, which is called Monero XMR,
okay,
which is a crypto, that's how it looks right now in dollar terms. Now, that is actually a higher high than this. The secondary high is actually a higher high than the high of 2017, December 2017. You probably can see it with a naked eye. However, if I just say, what is Monero in gold ounces, and that gold reflects a true basis of account, this is a much harder benchmark to perform admirably against. We still have a very interesting structure that is technically valuable to me. And actually, you can see it's been squared down. And this is a very long term. This is a monthly chart, by the way. So this is the last time I think alt tokens really had a meaningful, proper surge, was the 16, 17 December high. That was a real alt market for a lot of the big alt names. You'll see that actually then this didn't even make a higher high, but it gives you, in fact, a far better technical structure, which is very HVF method compliant on a long term. And we are still waiting for a suitable high to the 3 side before a major break. So at that point, I'll probably have, added to my investment position and maybe put in a leverage trade on that, because in gold ounces, it's given me upside beyond what I would expect from gold. Most other assets are not outperforming gold. And there's a select few cryptos. People can follow the Crypto Sniper YouTube channel if they want to find out more about those. But there's not too many. So there's literally 3 that we would investment hodl and accumulate and then put a leverage trade on as we get closer to the money moment on the breakout. But it will come. And gold is a real benchmark. And it takes out that which is going down in the fiats, which is actually a convexity, slowly at first, Ernest Hemingway's bankruptcy curve, suddenly very fast. We're in the accelerating phase right now, and that's why gold is having the moves it is, and that's why people can't believe it, because they think it's gold going up. Gold is the bubble. No, it isn't. It's gold doing what it always doing, holding value against a debt and fiat bubble in devaluation phase. It's a complete inversion. You have to invert it. Fiat and debt are in a convexity phase, losing an immense amount of value. We refer you to the TLT call we made in late 2020, which ended up being a 55% crash in long debts. And that has been put on hold for a bit on downside, whilst the dollar has weakened. So the weak dollar of this year has been taking the debt crash, but you will get further debt crash. That's why we're destined to face higher interest rates.
Understood. Now, I know you have something outside of the box that you want to look at. This is the, I'll let you introduce it, but what we're about to talk about could have ramifications as threats to the global economy in the form of a contagion. So, Francis, take it away.
Yes, so I mentioned to you I wanted to highlight this and just put my name on this one. You're going to hear this first. No one else that I've ever seen is discussing this, and it's a slightly bizarre. And some people would say, why do I even need to care? Because it's a global world and there's potential for contagion. South Korea is essentially like Japan, but a smaller version thereof, a slave nation to the Western hegemony, and will quite easily be potentially sacrificed. I've often referred that Japan, the yen, we see a weakening in the yen to 172. So that's not all about dollar strength, by the way. The yen will be weakening against the Chinese yuan, and we're going to see a major deval in currency for South Korea. And that is going to be to the tune of a minimum 50%. Now, that's a very advanced nation, high IQ nation. Your company champions, you think of Samsung, LG, Hyundai, and, Kia, popular vehicles. They're good engineers, they're smart people. They've actually got a worse demographic than Japan. I think it's 0.88 to Japan's 0.91 kids per couple. So, they've got some interesting demographic issues. But my personal feeling is that this is probably going to come down to a unique structural aspect of how they work in their stock markets and their pensions. In other words, it's not only America that has some form of Ponzi-onomics going down. And I think South Korea is about to get negative attention for a number of reasons. And by the way, just so that you know, beautifully how it's set up, this was a classic setup for the Korean won to lose a huge amount of value. But at that point, it was around 780 to the dollar. So we are looking at the dollar. We're looking on a 3 month. So every candle is a quarter, a full quarter. This is a very big setup. Only silver is longer and larger. And again, we keep bringing you the same kind of setups. This leads to fast-moving, violent upside breaks. This helps people trade from a low volatility position with a tight stop. We've been in this trade. This is actually our risk reward if it does transpire, by the way. We've been in this trade from there. That's a 59.41 risk reward. We've been in this trade for a while now, and it's starting to move like our expectations are having it. So I'm going to do the draw. By the way, that was an Asian crisis. That wasn't just Korea. That was more broad. That was, Thailand was affected by that, Malaysia, the ringgit, etc. They were all given a bit of a currency shakeout. I think Soros was called a locust by the Malaysian head, etc., etc. So it was an interesting time. But this is our setup, and this is why we are talking about deval through 2,740. Now, I want to point out, when things go bad for Korea, they go bad fast. Eventually, there's no bid. You can see this quarterly chart had a huge wick and then traded up again for another quarter, and then a huge wick down. You could expect gaps on this. Once it's really in trouble and the news has gone bad, it can go no bid. So you've got to watch liquidity. We have brokers. You can check which brokers are offering this trade on our YouTube channel that we utilize. They can pop over if you want to take it. It's non-advisory, but this is nice, rounded, calming bottom. That's our third high with a slap down over there. And this is a triggering event. Now, the first time, we have 5 phases that you typically go through on a breakout. First, you break and you feign back in. It's called the break and feign stage. It's stage number 1. Second stage, you typically break and you run at least to your first interim. So you'll see there's a light purple line there. Let me get that out the way. At 1582. You're currently at 1462. So that already represents a huge move. Don't be fooled by this chart. Remember, it's a quarterly chart. This is decades. That started in 1983 and the crisis with this huge spike, which we're anticipating will come again for Korea at least, and probably have some knock-on effect with some neighboring nations potentially, but mainly a Korean crisis that you'll benefit by being long the dollar on the one side or the Chinese yuan. Now, most brokers offer the dollar. You're not going to easily find the Chinese yuan against the Korean won, but I point out that it's not just a dollar strength thing. It's going to be mainly a Korean story. And then that got me thinking, what's the story? And I'll tell you about that in a minute. But so, yeah, you should run at least to the 1582. You can have a pullback. Then we have a big move to 2-1. What the point I was making here is the target was here, and you didn't even capture a third of the move. It still went two times more to the upside. So that's what I mean by this. The overperformance could be vast. So I might close some at 2,750, but I'm going to hold the position discretionally open for a super surge. So there's something coming to Korea. So that gets me thinking. Now, a lot of the people watching will think the normal stuff, North Korea, missile testing, maybe China maybe they get joined up. Imagine the cost of amalgamizing North Korea, like an East Germany into West Germany story, and they smash the leaders' heads. Who knows? These are unthinkable thoughts because they're supposed to be so antagonistic. So you think all the geopolitical things like that, but actually it can be simpler. This is a financial event potentially that we're talking to you about today. And I want to highlight for those of you that also might have a problem. As I say, we've got a couple of brokers in our links in YouTube. But let's say you can't find the USD Korean won, but you like the idea of the trade. I'm going to split the screen here and highlight the relationship with the KOSPI, and we'll talk more about the KOSPI in a second. If I put the KOSPI in here, which is the 200 largest shares in South Korea. If I put that KOSPI in there, and I'm hoping I've chosen the right one, and we get these rebased 1981. Okay, join, one under the other. Let's see. So what typically happens is when you have a surge in the Korean won. So these are now aligned under each other. I'm just going to reduce my artwork out and take the draw tool off, because it starts to get a bit busy when you have too many charts. What typically happens is when you have real contagion, you have a bit of concern, Korean won goes down against the dollar. So that's weakening Korea won. You can see the stock market weakening. Here you had a period of weakening into a low there. You can see
But
the
that's
stock
the
market.
dollar. That's the dollar relative to the Korean
That's
currency.
right. So if this goes, what we're actually showing is, in fact, let's get this straight and start again. So US dollar, Korean won. If it goes up, that's the Korean won getting weaker. The base currency is $1,
Right.
and how many Korean you get. Number go up, bad for the won, more buying power for the dollar. The Kospi obviously go down equals go down. So you'll see this crisis stage over here from once it started, and then absolutely super surged. You had a real collapse, started, super surge, real collapse in the Kospi. Then you got a kind of recovery, even at a localized high here. You can see the USD Korean won had come back down. The Korean currency the won had firmed up, coming down, coming down, coming down. Then we had a little bit of a wet the bed moment. Of course, it was 2008. So what this points to also is that there's some foreign direct investment potentially that is going into South Korea. As I say, big credit-worthy companies to invest in, like Samsung, we've mentioned them at all. But if they get spooked, they take their money out. So what happens? Kospi goes down and the won goes down, which means the USD KRW goes up. You can see it here. Then we've had a move up. We move up a very low volatility period on the Kospi, little bit low, and then recently we had a move up and a move down. Here we got a down move, up, down. So you can see the correlation. Now what's interesting is you're having a little bit of a blow off here that's coming under threat on the Kospi, and despite that, the currency is weakening. Normally currency Kospi go up, currency is going down. That means the Korean won's in a good space. People are buying Korean won to invest in the stock market. That's why stock market go up. But what's actually happening is you're seeing an inversion of that. So I started to think, why could this be? What is unique about the Korean won financial system? You can grok this. I've done it a few times. Depending how you ask your question, you get slightly different answers. But this is consistently what comes up. Their pensions. Their pensions have something that's very unique that no other nation is doing, usually because of regulatory reasons. So the Kospi, this will shock you as a fact, Danny. Stay with me here. The Korean won and the Kospi 200 index, tracking South Korea's top 200 market cap, is the world's most actively traded equity index by options market volume. So let me just say that again. South Korea has more options trading on its primary index than any other place in the world. And let's just throw some numbers in that. In 2024, it saw over 3.5 billion contracts. Go think about what that billion number is. You know, a million, 12 and a half days to count to a billion, 32 years, 3.5 billion. Dwarfing competitors like the S&P 500. I mean, I would have wailed in and guessed the S&P 500 has the most options. Think of all what Robinhood and all of that. South Korea has more. South Korea has more. Around 1.2 billion on the S&P. You're on 3.5 in South Korea. That is 3 times the options trading that goes on in America on the primary index. 3 times. And America's a stocks trading world. Retail is in there. Everyone is in there. You know, it's not the United Kingdom where it's just about property. That is a stocks trading place. What sets Korean call buying apart? Well, it's institutional players like their national pension service, which is set up as a structured, levered bull bias. Now, tell me if alarm bells start ringing. Korean institutions are consistent net buyers of call options for equity exposure. Instead of buying the shares, they are using derivatives, a strategy rarely seen elsewhere due to regulatory, risk, and cultural differences. He breaks it down later, and you can go have a read. But this smells like, wow, we have a downturn in that Kospi, you will have a melt up. What could drive it? Maybe a geopolitical event could drive it. I would love the people watching this video with us, Danny, and anyone who is in South Korea. I've spoken to a few people. What do you think will be the key event? Does it need to be geopolitical? Maybe it'll just be a crash in the Kospi. But what you can see is if the Kospi crashes, entire pension funds that have long dated calls, maybe short and medium dated calls, it didn't say much on the duration, suddenly start going into the red. And that means the ability to pay pensions. And then you could get real contagion. And then to hedge their positions, they might become big buyers of puts and short the market, because they suddenly fear they get a panic, and that could ripple very badly. And of course, the currency will get absolutely downvoted on that. And if there's foreign direct investment that sees an accentuated, amplified contagion collapse in their main equity market, you could have withdrawal of money from the Kospi by foreign investors, and obviously selling the won to get back into dollars, Chinese yuan, European euros, whatever the case may be. But there is a technical event coming that is going to see the halvening of the currency, and I wonder what damage it does to the index. And you've just had a little blow off that's been blown off on actually a steady weakening of the currency. So whatever happens now, we're seeing the currency actually get weaker. Imagine this starts to downturn. It's not in melt-up state, but we are predicting a form of major move that could have some similarities with that period over there. So that's your out there unexpected trade call. Put your comment in Danny's video, what you think it'll be, the main driver for this contagion. Will it just be the leverage of the situation? Will it be geopolitics? If so, which one? I'd be interested to hear. If you're in Korea, let us know. But that's a very, very interesting and precarious position to find yourself in, Dan.
Yeah, so I wonder if this has anything to do with it. This is I remember reading this article a few months back, and I just dug it up. It's from August 24th of this year, and it talks about how South Korea wants to normalize ties with China. And that's pretty profound. And you go read the article, and it talks about South Korea's new government will pursue a mature development of South Korea's China strategic cooperation partnership based on national interests while continuing to develop the South Korea-U.S. alliance. So
they're wanting to walk the middle line. They are a Western, like Japan, but I think they are recognizing it's a bit of a Ukraine's or what I'd say a Georgia situation. They don't want to be associated too strongly with NATO. They don't want to be associated against Russia. They want to maintain relationships and walk the middle line, I think. China's the rising beast, and they want to make the right kind of noises there. But in terms of practicalities, they still legacy history, like Japan, Japan very much post-war. We certainly suggest watching our Professor Werner video if you're interested in that, the peace agreement and how essentially Japan is a slave nation. Korea is in a similar situation, sadly. Don't forget there was also a Korean War. They're making positive musings to their growing neighbor, but I'm not sure that's the reason. I think it's leverage. It could be geopolitical events. Who knows? Maybe they want to merge the Koreas. I think it's an outlier thought. They're very anti each other, but they might be forced together.
But if I'm North Korea, East Germany. If I'm North Korea, surely they have the same intel that you have. I mean, why would they bother attacking South Korea in a conventional kinetic fashion if they can just wait it out and let South Korea crumble economically?
Well, in a way, that's what China and Russia are doing with America. We are in that. Just wait. They've just built up so much leverage and done so much damage to themselves. Just let them finish beating themselves up. You don't have to get involved in this fight. There's a Chinese saying that say, wait long enough on the riverbanks and all your enemies will wash right by. The whole thing is passivity. If someone is an aggressor, somebody is going to give them a clout at some point, or they're going to do themselves in due course. I would say that the same applies for all our Western nations. This is why I call it the synchronized leper colony, where you kiss the chief leper, which is Zionism, it is debt, it is casino banking, it is leverage. It's financialization of everything. You know, you get a mortgage on a car now in the States, 7 or 9 years, which is why actually, amazingly, point we haven't discussed, whole bunch of isolated subprime car players going bust. When I was driving around the States, I was astounded about finance agreements. You could do 7, even 9 years paying off half the damn car.
Oh,
And of
now they're
course,
pushing
don't
for
let's
15.
forget. Sorry, Danny. Say again?
No, now they're pushing for 15-year car loans.
Yeah. And don't forget on mortgages, Trump is just floating, hey, you want a 50-year mortgage? You know, well, the rates actually should be higher for a 50-year because the risk on the bank is a lot longer. And they'll be exposed where you haven't paid much of the capital off. It's still a longer period that you can just hand back the keys and you've effectively paid a cheap rental. So the rates are going to be higher. You're going to not save many more dollars and you're going to be in servitude for another 20 years. I mean, imagine buying a house at 30, and that's well below the average age of buyer right now because of affordability concerns in America, and you finish at 80. I mean, you're a very different looking soul. I'll be happy for you if you've got all your own teeth still, and you're still paying off that servitude. That is usury. That is an extension of usury banking servitude. And you don't celebrate that. We need to go the other way, back to sound money. This whole notion of Trump's doing you a favor, Trump's going to make it easier and more affordable. Affordability is not the question. The asset price is as expensive as it is because it's been hyper leveraged, because it's been financially leveraged. If more people had to save at least a third or a half for a house, the prices would be far, far less in actual fact. There would be less of an NVIDIA doom loop of leverage. But that's where we are. And so adding more years is there to actually support asset price and longer servitude, when in actual fact, a correction in property prices to more affordable levels and greater money down would actually give a far more stable environment for property prices. That's not the steps they're going to take. They are here to do a controlled demolition. And I mean, we've started throwing down our definitions. I should show you this. Of some of the things that are going on. And a controlled demolition is, by our definition, something that runs like this. You know, controlled demolition occurs when the parasitic forces hijack a thriving financial system, which was pretty much where the US was post-war, 40s and 50s, via insider control, extracting the maximum personal gain at the sustainability's expense. That's what's happened. We had, all forms of junk bonds and every notion of being able to create leverage, socialize losses. We saw that in 08, 09, privatize gains. We're seeing that on the basis trade, with essentially becoming too big to fail. The repo market liquidity is being supported by the Fed so that hedge funds in the Cayman Islands can keep buying treasuries. These are generally actions of willful intent, often framed as incompetence. It's not incompetence, it's intent. That's the key point. And they are shielded by typically captured politicians. You're shielded. So all these people are shielded by captured politicians. You saw Nancy Pelosi stand down. She's done 17,000%. She's outperformed the Dow. The best hedge funds battle to outperform the Dow. They fraudulently enriched themselves as genius speculators that literally could have been written for Nancy Pelosi, later ensuring systemic collapse. So they enriched themselves at an accelerated pace, creating greater blowback on the system as a whole. So they enrich themselves by making the system more weak and vulnerable, ensuring its future collapse. A network of cabal do asset stripping to the bone in a final destructive heist. This is what we're experiencing now, dumping the systemic costs on the masses. That is a controlled demolition. These are definitions that we're dropping now, and people need to understand. We're going to be doing it for each one of the key things. And that invokes tax scavenge mode. That actually brings, wait for it, Marxism. It actually brings the Marxism. Was I sharing screen? I don't think I was. So, I was. Okay.
No, you weren't.
Oh, sorry. Let me just. Thought I was reading from the thumbnail and everyone could see. Let me just show it super quick. I won't read it out again. But there's an image that goes with that. And that all brings about what other things we talk that will be coming. That's the controlled demolition that I was reading for you. And that actually brings about the communism. So an insider cartel hollowing out the system, they frame the outcome as one that needs more Marxism, more control, more centralization. So by them stealing from you, and then you get tax scavenge mode, because, and by the way, tariffs are a tax. The reason he's talking about giving everybody $2,000 is because he's been taxing you. It's a small rebate against what he's been taxing you, because inflation has been going up. They're hiding it, and it's the next lie to be exposed, like the labor. So tax scavenge mode occurs when governments that have been covertly taxing you through inflation, that means they have been diminishing your buying power of your money, and your cost of living is going down, and excessive debt expenditure. So they've been overspending to the income and adding it to debt, which is proliferation and dilution of your buying power, have to revert to totalitarian new. They have to revert now because the ability to raise money in debt is being reduced. So they revert to totalitarian new taxation initiatives. And tariffs is the beginning of many. Wait till you get a Democrat government back in, and cuts to the service contract. So your dustbin will be only cleared once every month instead of once every 2 weeks or once every week, if you are lucky to have that. Once borrowing has become too expensive and untenable. So and we are going to see the interest rate hikes. Powell already said the following, which confirms our stagflation review, by the way. The rates are actually too high for inflation. They have a target of 2%, and it's at 2.7, going on, I think, 3 in their fake numbers, not in real numbers, not in John Williams shadow stats numbers, but too low for the job market. That is the perfect situation where you have, he's just described, economy needs lower rates for the ban in the street just to get by for economic growth, but the inflation actually needs higher rates. And they're having to walk a middle path, which is neither. And what ends up happening is you're too low on the inflation and the rates go up. It doesn't matter how hard it is on you, the rates go up, the debt market starts falling. And after that after the rate cut that we had 2 weeks ago, I believe it was, what happened on the US 10 years, it started to go up. It started to go up because actually it was quite bearish, the December cut. You haven't got that one baked in near as much as you think. And there was quite a lively debate about just the one you did get. So warning to people, don't expect rates to continue going down, but they are providing liquidity, which is also a fire and water. On the one end, you're saying you might slow down, you're being hawkish on rates, and you may not get the December. But on the other end, the system needs liquidity. So, I mean, you're pouring petrol on one side of the fire and you're putting water on the other side of the fire. So, I mean, it's a perversion. It is end of days of system, and the cacocracy and the corruption that Pelosi and all the others that have front-run Palantir stock awards or contract awards and everything else. You know, he was standing next to Schwab while you're saying, and you made $1 billion today, you know, when he was announcing tariff cuts and various other things. Brokers who knew what he was going to say. You go to the crypto liquidations and how they've been building their wealth. This are people enriching you at the cost of the system. They're enriching themselves, impoverishing you, and also structurally destroying the system. And then they'll bring Marxism, a totalitarian Marxism, and they're going to go aggressive on tax. So, I mean, it's an absurd situation we find ourselves in. But
no, you make a great point when it comes to the interest rate, because it kind of goes hand in hand with this gold situation that we're in as well. You look at a long-term chart of both gold and the 10-year. Gold's really been in consolidation mode since about 1980, and that coincides with this lowered interest rate environment that we've been in since then. And the big gold rally that we saw in the late 70s and early 80s, that coincides with a spike in interest rates. So there's actually historical precedence to this. It actually goes hand in glove with the gold price.
Very good point, Danny, because everybody tells you if rates go up, gold can't go up. because you're getting a better yield. And it wasn't about rates, it was about capital preservation. The bonds were not fairly priced. The bubble is fiat and debt. And when they go down, the rates go up. And when they go down and people are exiting, that leads to the rates going up. They're exiting for a preservational asset, and that's gold. And that's what happened. Volcker raised right up to double digits. You can't do that this time. It's not the same America in terms of debt and everything. It's far more sensitive. It's not the same economy. So gold is the winner. Gold is the winner as the unit of account. And very few things, we mentioned a couple here today, will be outperforming gold. And that will be real alpha. But if you don't know, just having gold is going to keep you in a preservational level state where everyone else is on the convexity bankruptcy curve.
Yeah, there it is. So you've got the gold price here in the candlesticks, and you've got the 10-year yield in blue. And you'll notice that, when we had this big rally in gold back in the 60s all the way up to the 80s, interest rates are going up here in blue.
Yeah. And they were rising because of excess spending in the Vietnam War and the cheating. It's a trust. This is a crisis in trust. The French called for their gold because they saw what America was doing in Vietnam. They were in Vietnam before America. So when they saw how much bombing and how much nuking and how much Agent Orange and how much everything and flying planes and sorties over a war, you go to the other side of the planet. Think of the oil cost alone of aircraft carriers, troops, food, everything, logistics. You don't do war on the cheap. There is just no way. And they were doing it on such an astronomical scale. The munitions that were dropped in the jungle exceeded all of World War II in a single war between two nations. The only reason Europe didn't understand this is because most of the population was insulated from it. It was just some battle far away in a far off land. We are far more traveled nowadays. We've got to remember most people hadn't left their hometown in that area, and only a few people were worldwide travelers. That was an unseen, huge endeavor, huge, that spanned 3 presidencies, JFK, LBJ, and Nixon. That was a huge endeavor. And the French said, there's no way you're backed still. You've just created so many dollars for this endeavor. There's no way you're still backed. It was a crisis of trust. And tell me where we are now today. How's trust in fiat and debt right now today? It's a crisis of trust. And when you have a crisis of trust, there's only one thing that's still there. Every day, this is still 100 ounces and it's still 4 nines. Doesn't matter what happened. Doesn't pay me any interest, but it still weighs the same. It still looks the same. It still shines the same. And the only thing is, in the paper terms, it's going to keep going up. Throw their monkey money back at them. Get yourself physical. That's the key message. It's a crisis of trust. It's a debt-based collapse. Anybody who says gold or precious metals is a bubble is delusional. The real bubble is the system that they have in a controlled demolition manner set up and destroyed. That's the message. It doesn't get any simpler. Watch for the Korean won trade as well as part of one of the other dominoes. It's a point of interest. It's a massive pattern. There will be a trading opportunity if you're interested in how we'll be exploiting that. We're already in it, and how you could too. Pop over to our channel at themarketsniper.com. There are a few other areas where 1 or 2 things might have an outperformance to gold that we'll be trading in, but the foundation trade is your precious metals. Thanks for having me on, Danny, and I hope it was interesting.
Always interesting, my friend. Where can people find you if they want to see more of your work?
For the traditional markets, The Market Sniper. On X, The Market Sniper. For crypto, The Crypto Sniper, also on X under the same name. And there are links there to book a call if you want to talk further about how you can turbo stack. Because here's the opportunity, really. Some people are waking up now, and they haven't been long-term buyers of precious metals like, say, you or I. And they think, how do I fix this hole in my balance sheet because I'm sitting in fiat and it's in an escalating state? You can turbocharge your way with judicious, low risk, low margin, speculative trades that are not day trading, that are held for an extended period. I'm on a laptop here. I don't have 9 screens. I have a mobile existence, It doesn't require 14-hour days. Most people think, we're day traders. We're absolutely not. We're investors, and occasionally we put a little bit of leverage on it at the key moments. And we use HVF method, like you are seeing. Gold, silver recovering, there will be real trading opportunities inside of the move, and we convert that into stack. That's what you do. So the safest foundation is your blue pot, which is your investment gold. If that makes sense to you and you'd like an opportunity to speed up the process of how you can stack through that, come to us. We aim to help you build wealth during reset times, preserve that wealth, and secure freedoms and optionalities in a growing totalitarian Western world. And I'd like to suggest these are the times you are in. And sadly, on a closing point, Danny, I mean, the nurses, they should be the ones that are looked after. This is a speculator's economy. That's how it was created. It's a casino economy. Well, we understand judicious investment and trading, and we're helping people save their life financially in economic terms and buy themselves optionality. It's a sad fact that the vocational people doing work will be part of the large amount. They're going to find living much harder and life more expensive. You can be a leader in this space and help your family and those that aren't financially inclined, because this is a financial and economic times. This is an epoch of capital preservation. It's the most important thing to do. It's not all about money. I love life and all of these things. But right now, this is the financial preservation epoch. And those that don't give it any time or thought will be part of the masses that's in this polarizing event, will end up as working poor and will need UBI and be reliant on state. And that's not a place to be. They don't love you. They don't look after you. They see you as cattle. And that's my finishing note. Thanks for having me on. And as always, I enjoyed it.
Always a pleasure, my friend. Guys, and also if you want to look into more stacking when it comes to your gold and silver, consider becoming a member over at the Bullion Standard Pro and unlock wholesale at cost pricing on your gold and silver. It's $35 a month, but you can get 10% off your first month by using promo code COSM10, COSM10 at checkout, and by clicking on the special link down below in the description box and the pinned comment. And if you enjoyed this podcast, drop us a like and comment, go Francis, go in the comment section. If you agreed or disagreed, either way, let me know your thoughts. I do, in fact, read every single comment. So drop me your thoughts. I'll read them all, good or bad. Always interested to get your feedback, guys. So, and also subscribe to the channel so you don't miss an episode. And by liking, subscribing, and commenting, you enable us to get boosted in the algorithm, both for this channel and for this video and for this message. So if you'd like to support us in a nice and easy way that's free, everyone's favorite four-letter F word, then a little bit goes a long way. And then finally, check us out on Substack at CapitalCosm.substack.com to get access to all of my stuff early, ad-free, and uncensored. With all that said, I appreciate your time, guys, and I will catch you later. Bye.